Good morning. It's Saturday, April 2025. It's just after 11 a.m. on the East Coast. This is Rob Sin at CEO Technician on X, at Goldfinger on CEO.ca, and this is Goldfinger Capital. As always, if you enjoy these videos, if you get value from my content, which is my goal every single time I make one of these videos, please hit the like button, subscribe, and feel free to share with your friends and on social media. I got a lot to talk about, but I'm going to try to really be concise, not be too verbose in this, get to the salient points. And again, I approach all of this from a trader standpoint. What's actionable? What's valuable? What are some insights that can give the viewer some ideas, right? Some trading ideas, some trade setups, something to make some money, not theoretical TA and ratio analysis and all and all the intermarket stuff that can sometimes give us some insights, but not really very actionable. We'll talk a little bit about the gold silver ratio later. So not going to get into politics, tariff stuff really, but I'll just say the broader market bounce has not been convincing whatsoever. The S&P got up near 5,500 briefly. We closed under 5,300 on the cash S&P index. Not even a 50% retrace of the decline, right? The February to April decline didn't even retrace 50% of it. The NASDAQ 100, the QQQ, even less convincing. Dropped almost 30% from the February high, bounced about 15% at the peak there a week or so ago. But now it's basically 10% off the lows after giving some back on Thursday at the end of last week. These charts, I mean, you don't have to be a TA expert to kind of see the dead cat bounce in these charts. Yeah, we had that one day, that huge up day where the tariffs walked back a little bit 2 Wednesdays ago. Massive short covering rally on that day, but there's been no follow through. Yeah, so this is just, it's unconvincing. It's very unconvincing. But as much as I want to just blindly short this market and bet against it, I have a feeling that there could be a little more short squeeze left here. And it kind of has to do with these trade negotiations going on in the background. We know the administration wants to announce some victories, but trade deals don't happen in 3 or 4 weeks, right? But they could announce some watered down version of a trade deal with a number of countries. Obviously, put South Korea and Japan up there near the top of that list, maybe even Australia, Vietnam, et cetera, et cetera. But these aren't going to be like the final trade agreement. It doesn't happen in 3 weeks, right? But they could announce some victories that could create some positive headlines, that could create more short squeeze, a little bit of a rally. But the emperor pretty much has no clothes here. So instead of trying to short in the hole, I prefer to wait for the rally, short squeeze to come to me and fade strength, right? Just like we saw there a week and a half ago, right? If you actually shorted at the end of that huge short squeeze day, well, you had a profitable trade within 24 hours, right? And then early last week, same thing, right? So we want to sell into strength, not really try to short in the hole here. But at the same time, I wouldn't be surprised if the S&P is up 100 points or 150 points early next week, and I wouldn't be surprised if the S&P is down 100 or 150 points. 150 points early next week, right? It's that kind of market where flip a coin, they could generate some headlines that could trigger a rally, some tweets or whatever. And at the same time, we could have some more of this tough talk on China that could trigger more downside, right? So it's really a tricky spot here. But just objectively viewing the health of the overall market structure, it's not healthy. It gets a low grade here, right? This is a market that has been knocked down took a 7 or an 8 count, got up woozy, landed a couple of counter punches, but the fighter's still not all there, right? His legs aren't there. He's a little woozy, and he could get knocked down and knocked out again very soon. Okay, there's my boxing analogy. It's not a healthy market. I want to make some comments about put call ratios and market sentiment. So we know sentiment is very negative, right? Like the survey sentiment, the University of Michigan, blah, 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 all the different Fed surveys, CEO confidence is low. Right, we got it, right? The talk is negative, the talk is uncertain. But look at how these put call ratios ended last week. So the index put call is generally a measure of professional investor activity, right? So they hedge via puts their exposure, right? So they're generally long investors. They own the S&P, they own the Nasdaq, right? And they use the puts and calls on the indexes to hedge or express a more bullish view, right? So they started hedging at the end of last week. Professional investors were buying puts at the end of last week. This is the retail investor measure of put call activity, right? So retail investors were not buying as many puts, they were buying more calls at the end of last week. So retail money is getting more bullish just with their feet, their activity, right? They're buying more calls, they're buying less puts. Professional investors are buying more puts. I don't think we should ignore that, okay? Also, look at this from Bloomberg. Retail investors are plowing into leveraged long ETFs. 6.6 billion. So that's not chump change. Like that's like big hedge fund money, 6.6 billion. So the total, US retail investor audience, I mean, this is near record weekly inflows to leverage long ETFs. I mean, it is record. Sorry, I missed the first word. Record influx. It's record leverage long. So these are the 2x, 3x long ETFs. 3x, right? So they're so bullish, they're so willing to take risk here, they're buying the 3x vehicles, right? So they're not buying puts, they're buying more calls now, and they're going into the 3x leverage long ETFs. Whereas professional investors are hedging. They're doing more hedging activity at the end of last week. Just put that up. So forget about your opinions on whatever is going on in the macro backdrop or what the administration or trade agreements are going to be. If you just look at that data, that activity, and overlay it on the SPY and QQQ charts and the overall, go through the different sector charts, which I'm not going to go through, but you can do it. It's not a healthy backdrop. This is not the market where we want to be taking a lot of risk. You take some risk, one toe in the water, sure. Have a plan, trade setup, sure. But this is not the the risk on market environment. And then if we look at the actual conditions, right, like growth, inflation. So this chart from Goldman Sachs is pretty helpful. So inflation is actually moderating, borderline declining. I don't know if you can see it, but they have a little trace, the blue dots, showing inflation falling, right? So their forecasts are actually inflation is moderating and growth is moderating, right? So it's pointing more and more like a stagnant, um, weakening economy, quite frankly, right? And the stagflation word is getting thrown around. I mean, we have to see how the tariffs go, and nobody knows at this point exactly what's going to happen. But it seems to me more likely that we get the stagnation and not the flation part. Okay, that's what I'm sensing more and more. Just canceling activities, canceling shipments because the tariffs are too high. And obviously, this is a very fluid situation. So when Powell gets up there and gives the speech at the Economic Club of New York and just talks about how they need to go slow and the risks seem to be to lower growth and potentially higher inflation, but they're not sure. They need to actually see some of these policies in writing and on paper to be able to study them and ascertain and come up with some better forecasts, right? Like, he's right. So they can't. The Fed should not be acting knee jerk here. I mean, obviously, if the Treasury market is blowing up like it was a couple weeks ago, they're going to act, but it has stabilized. So the May rate cut looks unlikely at this point, right? But June, still, I believe, a very high probability of a June rate cut. May rate cut probably not happening at this point unless Treasury market becomes unhinged again. But June, I think, will be very much on the table because the growth slowdown is very significant. I mean, at this point, we have to be expecting the unemployment rate to begin ticking up and growth data and growth expectations to be ticking down. I mean, this is a major reshaping of the global economy, and we cannot uh, take it, take it lightly. But it's interesting to just look back at this chart and like we had a growth scare last summer, right? That wasn't that long ago. That was last summer. And then all of a sudden everything was fine, right? So it's a fluid situation and policymakers can affect the outcomes a great deal. Like we had a growth scare last, I guess it was August. What happened? Fiscal side, the US fiscal side was spending money at the end of last year like a drunken sailor. The deficits, the monthly deficits like August, September, October, just massive. We're talking like 200 billion plus monthly deficits. I think there was a couple months where it was over 300 billion monthly deficits. So the government is just pumping money into the economy. And then the Fed did that 50 basis point rate cut in September, right? So there was major policy action at the end of 2024 to avert and sort of cause this U-turn in growth. Well, here we are again, right? We've got another growth scare. What's the response going to be? So far, Fed is on hold. I don't know what the administration's going to do, but I don't know if they know what they're going to do. And then earnings revisions. Look at this. I mean, so just looking at the accumulation of data, this is not a great setup for equities. Now, that being said, we know that this is a tweet driven, headline driven market. So from day to day, anything can happen. But if we look at the trends, the bigger picture trends, like you can see the months here. This is more than one day and one tweet. These are actual trends in corporate earnings, revisions downward, downward. And this is a pretty robust trend that's now intact for several months in a row. Okay. And I don't think this is the time to be trying to be Mr. Genius Trader and fading the trends and calling bottoms. I know that, and I mean that both ways. Like there's uptrends out there in different asset classes, like gold. I don't think we want to be that genius trader trying to call the exact top on gold. This is a very powerful trend. Energy stock. So it's interesting because this new administration had this drill baby drill theme during their election campaigning. And look at Halliburton chart, right? So this was November, above $30 a share. Well, it just bottomed below 20, and it's also dead cat bouncing. I feel like under 20 obviously was a great buying opportunity. I feel like this is very oversold and overdone to the downside, but this is again one of these trends. This is a very pronounced downtrend and it's rallying back a little bit, and maybe it can rally back more. Maybe it can get back to 24. I don't know. But this is still a very pronounced downtrend that is not indicative of a strengthening economy. So just keep it simple, stupid. Forget about my opinion of the company or the outlook for the oil price or whatever. This is telling us about trends in the economy, in the US economy and also in the global economy, because Halliburton is a global oil services company, right? So all these trends, another trend, next gen, right? This was one of the sectors, one of the stocks where I was buying in early April, made the trade. I'm out of it. I was hoping there would be a bigger bounce in these stocks, quite frankly. I mean, next gen got more than cut in half since the end of 2024. Drops under $4, and okay, we got a 20% bounce from low to high, 20%. You know, not great. And notice where the rally ended, at the 40-day moving average, right? This downtrending moving average. So, not making a call on this. I think uranium is still very much a great long-term sector to be in. Nuclear energy is not going anywhere, but just looking at the overall health of this market, the fact that these bounces are so weak, it's telling us something. Chemico, same thing. US dollar. So, this is probably the most important chart in the world, the US dollar index. I know a lot of people have their different most important charts in the world. It could be the 10-year treasury, it could be high yield corporate spreads, whatever. Everybody's got their opinion, and that's great. We should look at all the charts. But this one, look at that drop since January. I mean, this is a precipitous decline for the US dollar. Now, it's had these kinds of, declines before. I mean, we usually get a big move in the dollar every couple of years, either up or down. You know, we went up at the end of last year. Now we went right back down, right? We're under the September 2024 low, and actually we're under the July 2023 low. So this is a major test, 99 100 level for the US dollar index. And if we zoom it out even more, we can see, wow, this is pretty big. Does it hold here, right? It just trader hat on, you would expect a bounce off this level. This is such a big long-term technical level. I would expect at least a rebound to like 101 or 102 in the near term. If we don't get that, and this cuts through here like a hot knife through butter, well, that is speaking volumes about global investors fleeing the US. I mean, obviously, there has been a fleeing of the US in the last few weeks. Everybody knows that, right? But you would think that these major long-term levels would have some support to them. They'd be a little more robust and not so easy to cut through. There would be another side to the trade who'd be willing to step in here. We'll see. I mean, I don't I don't know of any other, certainly not in my lifetime, maybe if we go back to the 1800s or something, another US president that has done so much to damage the US dollar in such a short period of time, right? And the tweets about Powell and the Fed, that has got to concern you. If you have investments in the US, if you have dollar denominated assets, I mean, the dollar is the underpinning of the global financial system, right? And so there's a reason why we have a Federal Reserve and a chairman who is independent, who serves 5-year terms, and he's appointed by the president, and then he serves out his term, and he can be reappointed, and yada yada yada. It doesn't, not voted in by the populace. Congress people can't remove him. Although there's a lot of gray area in the law, and there's questions. Well, what if there's a 60% majority in the House and 60% in the Senate? Could they remove the Federal Reserve chairman? Or president can remove him for cause. Well, what does for cause mean? There's a bit of a gray area, but it's just, we've never been here before. There's never been a situation where a president has been tweeting daily about how stupid the Federal Reserve Chairman is and how he wants to remove him, and telling the Federal Reserve Chairman what he should do, like how to do his job. This has never happened before. And there's reason why it's never happened before, because the president knew that if he messes with the independence of the Fed, he's messing with the underpinning, the foundation of the financial system. And you just don't do that. Well, the dollar's under fire here, right? And so when people want to talk about gold is overbought, a lot of tweets about how gold, yeah, we know gold is overbought. We know it's had a big run. Got it. It went from 2,700 to 3,300 in a couple months. Got it. But why is it happening? Look at this. The dollar, the shakeup in the global trading system, the global monetary order. This is big stuff, people. And gold is like that one life preserver that investors can flee to. 3,300 is a high price. 3,500 is an even higher price. 4,000 is an even higher price. I don't know how high this can go, but I have no desire to short this. I have no desire to try to be a genius and call a top, because I think more likely you're going to end up looking really stupid and leaving a lot of money on the table trying to outsmart yourself and time this, okay? The simplest trade since 2023 has been to be long gold. Since I made the video in October 2022 at 1650 gold, talking about the bull case for gold, it's doubled, right? That's the simplest trade. And why overthink it when all these things are happening in the world and a US president is talking about figuring out how to remove the chairman of the Federal Reserve before his term is up. Record inflow to gold. Yeah, that's a big inflow. It's overbought. Maybe a little too much emotion in the gold market right now. Could it pull back 2%, 3%, 4%? Sure. But in the grand scheme of things, gold dropping from 3,350 to 3,200 is nothing. It's a drop in the ocean compared to the potential further upside that could happen with the reshaping of the global trading system, the world monetary order. I don't think we want to overthink this, guys. Newmont earnings Wednesday after the bell. That should be big. Newmont typically disappoints. 3 out of 4 times they disappoint on earnings. I'm going to say this is going to be a very strong quarter with some very strong guidance. Knock on wood, willing to step out on a limb, put my foot in my mouth here. I don't think Newmont disappoints this time. Talked about gold. Yeah, it's overbought. It's overbought. It was overbought in early April at 3,100. It was overbought in February at 2,900. It's overbought at 3,326. So what? Gold bugs index, Huey. Look at this chart, guys. This is a big monthly chart, long-term chart. That looks like a big rounding bottom, a big base to me, and we're just breaking out. This is, if this holds on a monthly closing basis, especially if it gets above 400, this is a breakout. This is a major long-term chart pattern breakout in the Huey Gold Bugs Index, right? So why would we want to fade this and try to be too clever by half and call tops? Forget it. Gold silver ratio. A lot of comments on the gold silver ratio. I don't. Some people like to talk about the gold silver ratio. They think it makes them sound smarter. Something I don't know. It's the price of two metals, gold and silver, a ratio. Once every 5 or 10 years, it reaches an extreme that could be informative in some way, like the COVID crash. The ratio got really high, but it was high in the end of 2019 at 90. It went even higher above 110, right? So I don't think absolute levels are very valuable. You just know, well, it's really overstretched, right? In 2011, mining stocks and silver went full retard in the first half of 2011 when the ratio dropped all the way to 32. Well, that was a sign that silver was at a top, and you probably should have sold all your mining stocks then, right? But we can only see these things in hindsight. And when the rubber band is getting more and more and more stretched. It's very hard to gauge how stretched it will get. I mean, from 60 to 32, that was a big downside stretch. From 80 to 112, that was a big upside stretch. Now we're in the midst of what looks to be another big upside stretch. And, some people are saying that, it's the time to buy silver. Well, maybe, but central banks don't buy silver. I don't know what the new range of this ratio is. It could be 80 to 120. So if 120 is the new upside, well, it could get even more stretched. I'm not really sure how the gold silver ratio is really informing us of any actionable investment or trading ideas. And it doesn't look extreme. It's not extreme to me yet. Okay. Um, we're seeing re-rating. So I am gold. I've talked about this a lot in many videos going back a couple of years. It was my top pick in the producer space a couple of times. Yeah, it's overbought. This is really overbought. We could have a correction in these charts. We could drop 10% next week, no doubt about it. But this is a breakout. This is a long-term breakout, and this is a fundamental re-rating of producers and junior producers like Integra. Yeah, spinning top candlestick on Thursday, large bodied red candlestick. This could drop back to $2 next week. Totally get it, right? I'm not telling anybody to chase these stocks here for short-term trades, but bigger picture, these are major fundamental re-ratings to the upside. The hedge fund analysts, the investment banking analysts they're redoing their models, and they're saying, well, what if the gold price average is 2,900 or 3,000 or 3,100? What are these companies worth? And that just changes the calculus on all of these projects and all of these cash flow models, right? And so I think we're seeing that. And the junior producers, the ones with under 200,000 ounces of production annually, potentially stand to benefit the most, right? Because to them, you know, if their average cost to produce an ounce of gold is 2,000, if all the models were looking at 2,500 average price, well, that gave one level of cash flow and profitability. But now if you double that and you say, well, now the price is 3,000, well, just all of those numbers just doubled or maybe even more than doubled, depending upon what their cost structures are, right? And so the valuations are a lot higher. So that's how you can get a stock like Integra to jump from 150 to 250 in a couple of weeks, right? Trump order on critical minerals. Read this. This is on my Substack. A lot in here. A lot has to be done, but the biggest one is just expediting permitting. What are they going to, let's see the meat on that. What are they going to do about permitting? And then what are they going to do about investment in refinery smelters and processing, metals processing, chemical processing? This is the infrastructure that the U.S. needs. So we can talk about, doing more exploration. We could talk about building mines, but what about the refining and processing infrastructure? We need to build a lot of that. It doesn't happen overnight, right? And to build this, it's going to have to be done by the federal government, right? There's just not really the private capital to build these really high cost kinds of infrastructure that require a lot of environmental permitting, a lot of risk involved, and the margins are often pretty small, and it's a cyclical business. It's just not attractive to private industry. So the government's going to have to fund it. We also need to ally with countries like Canada, Australia, Mexico, et cetera, right? So it's multifaceted how the U.S. ensures and reshores its critical minerals supply chain. Okay, and then this Ivanhoe Electric got a letter of intent, basically outlining $825 million of debt financing for its Santa Cruz copper project in Arizona. Ivanhoe Electric has like an 900 million US market cap. It bounced on the news, but you can see this is a pretty strong downtrend. I think the way to play this is to invest in the neighbor, Arizona Sonoran Copper, ASCU. It's literally Ivanhoe Electric's neighbor at Santa Cruz. with the Cactus project. They're both porphyry copper systems. It's basically a porphyry cluster, a porphyry trend there in the Arizona copper belt. And ASCU has like a 200. So I like Arizona Sonoran because it's at a lower valuation. And actually, they are probably faster into production relative to Ivanhoe Electric at Santa Cruz. Ore body is closer to surface. There's more infrastructure, shallower. I think they're further along, quite frankly, in terms of the feasibility work on the project. And I think it's possible they could be in production by 2029, certainly by 2030. And most likely, this will get scooped up by a larger company. And actually, it makes sense to put Santa Cruz and Cactus together. They're across the highway from each other, right? So yeah, I like that one versus Ivanhoe Electric just because of the valuation, differential and the faster timeline to production. Hercules Metals put out a news release Thursday. A lot to unpack there, a lot to dig into. I recommend anybody interested in the company to read that twice over. Chart is a mess. It's messy. There's not really much to say. It's a mess. And obviously, the only thing that's going to really, or the main thing that's going to move this forward is going to be drill results, right? And so the good news is drilling is about to commence. So the catalysts are on the horizon, but obviously, the catalyst could be either good or bad. If the drill results are not good, then it could fall under this 50-cent support level. But I dig into it in some detail here on my Substack. It's a premium post, little teaser here, and then there's a video that goes along it, with it, about a 40-minute video. So I invite you to subscribe to my Substack because really these videos definitely give an insight into my thinking and stuff I'm looking at. I give you my best, but 30, 40 minutes a week is not everything, right? There's more, and the Substack has a lot more there. Emerita Resources. So EMO on the TSX Venture. First of all, I'm not an expert on Emerita. I've owned the stock on and off over the last 4 or 5 years. I think I made 4 trades on it, 2 profitable, 2 unprofitable. So I'm definitely not an expert on Emerita Resources. I'm not an expert on the Spanish legal system. I'm not, but I am an expert on junior mining. I think we can say that. And I'm also an expert on technical analysis of junior mining stocks. So this is my take. And the reason why I'm weighing in, because situations don't, like this one that's setting up in Emerita, don't occur that often. Supposedly there's a court case ongoing in Spain, in Seville, Spain. Again, I'm not an expert on the Spanish legal system. I can't handicap what's going to happen there. But I look at the chart and I look at some news the company put out at the end of last week about a ruling on a related matter that ruled against them. The court ruled against them. And I say, oh, this is setting up for a not so good outcome here. This is a head and shoulders top. It's not a confirmed pattern yet, so it needs to break the neckline. This is not a triple bottom. Somebody's saying it's a triple bottom. They don't know what they're talking about. It's not a triple bottom. For a double bottom or triple bottom, you need to test the level and then get a strong move up from the level on volume to confirm that it was a bottom. 2 red candlesticks and a downtrend is not a bottom. It's not a double bottom or triple bottom. This is a topping pattern. This has been in a topping process since the very end of 2024. And if it breaks this support level, I fear what will happen next. Okay. The technical indicators, MACD, bear cross, the RSI is rolling over and pointing lower. I see people telling me that this is a slam dunk and this is the greatest thing since sliced bread, but I don't see it in the news flow from the company, and I don't see it in the chart. And really, I think corporate news flow and price action in the market, some of the best data we have to go off of. Again, I got no dog in the fight. I'm not long or short. I don't want to see people lose money. I'm just calling it like I see it. Again, I'm not an expert on the Spanish, legal system. So maybe, this is about to go really well for EMO shareholders, and the stock's going to be above $2 a share soon. I don't know, but I'm just looking at the price action. It doesn't look great to me. It doesn't look like a good outcome is coming here. Alphamin. So this is one where I talked a lot about this in March, early April. Looks like we had a good outcome here. Looks like there's some peace in the DRC. The rebels pulled back. It seems like the U.S. is getting involved in the Congo with a minerals agreement with the DRC government. And just notice, this is an island bottom. You don't often see these gaps like this in the chart. And a bottom like this. This is a very rare bottom, and it's a powerful bottom. And I wouldn't be surprised. I have no position here right now. I took my profits, but I wouldn't be surprised if progress continues in the DRC, production comes back online, we get a quarter or two of cash flow, and this gap fill up near 110. The gap at 110 fills over, let's say, 3 to 4 month time frame. I wouldn't be surprised. And this is an island bottom for the junior mining TA textbooks and for the history books. Beautiful, beautiful bottom. And take a look at my Substack again for some more content on Alphamin and how I read this chart. I want to be looking ahead, so I don't want to always be looking at the past of what's happened. I want to offer some setups in advance. And this one, American Eagle Gold, reminds me a little bit of the Alphamin chart. The gap down, it's been working on this bottom for the last few months. And, we know that drilling generally, resumes in the Babine region of BC in May, maybe mid-May, maybe late May, but in May. And so looking at the calendar, we're about a month out from drilling. This is a company that has $35 million in cash. They've been working hard all off season to plan for this year's big drill program at the NAC Copper Gold Porphyry project. And so this is a kind of setup where it's really quiet. Stock hasn't had much activity for a few months. CEO hasn't been talking a whole lot, but I imagine when the drilling gets started next month, there's going to be a lot more activity. There's going to be a lot more news flow, and maybe this gap gets filled in here. I don't know, what is it, 65 cents or something, somewhere around there. So if I look at it, if I could buy it at 45, I know there's big support at 40, so my downside is maybe 10 to 20%, and there's the upside to the gap fill at 65 cents, 40, 45% above my entry level. That's a pretty good setup. So just pointing it out here, American Eagle Gold reminds me of Alphamin a little bit in terms of the chart setup and some of the potential catalysts. Obviously, there's no civil war in BC. Well, at least I don't think there is. Hopefully that won't happen. I know there's an election coming up. And that's it. Just some ideas to throw on your radar in the junior mining sector. As always, if you enjoyed this video, if you get value out of my content, please hit the like button, subscribe. Helps us get a better, bigger audience and a lot more great content coming in the next couple weeks. Cheers. Have a powerful trading week.